Matthew Copley here with Copley Financial Group, and today we're going to do a market update, and what a month it has been. I can't believe the big changes in the stocks, the volatility. S&P 500 down almost 10%, Tesla stock dropping 50%, gold prices hitting all-time highs, and all kinds of chaos with the tariffs in the economy. Let's get started. So let's talk about the stock market. S&P 500 down 9%, NASDAQ down 13%, Nvidia stock down 25%, Tesla stock down 50%. We've seen even Bitcoin drop 30%. We're seeing massive changes in the market. We've seen a recent rebound over the last few days. Markets are still down for the year. In the same time frame that the S&P 500 was down 9%, the Copley Tactical Fund was only down 2%. And we're actually up 3% on the year with that. And a lot of that has to do with the gold prices, the positions we have in the inflation hedges. The value stocks have done extremely well. And so when you look at this kind of volatility in the market, it is not a time to panic. We get a lot of clients concerned. They call and say, hey, I want to get out of the stock market. I'm worried. This is a normal stock market drop. In fact, when you look at market pullbacks, 10% plus pullbacks in the stock market happen. They happen generally every 18 months or so. So this is not unusual. It's not a time to panic. But we do want to look into the data and the reasons why this is happening. One of the reasons that we are seeing a lot of volatility in the markets is because of the trade war, the tariff talks. Donald Trump talking about 25% tariffs, then 50% tariffs, and tariffs on French wine, and tariffs on Canadian aluminum. When you start having this kind of chaotic delivery in the tariffs, it's going to create a lot of uncertainty. It's going to create a lot of volatility in the stock market. Now, I honestly think that a lot of the long-term benefits of some of these tariffs are going to be apparent in the future. In fact, when you look at a trade war, tariffs are always bad. They always hurt people. All tariffs are bad. It's a tax on people. But not all tariffs hurt everyone the same. And so when you look at tariffs, a lot of the tariff plans that Trump is doing, and I think a lot of it is negotiating tactics. He's trying to get other countries in the world to reduce their tariffs on American-made goods. Now, this could be a long-term positive impact, but what I would really like to see are these conversations happening in private and then a public implementation of the tariffs after the fact. When Trump is on Twitter and just firing off all of these tariffs here, tariffs there, oh, we're going to double the tariff. This kind of stuff creates a lot of uncertainty, and people, business owners, people in the economy, they are making decisions based on what they think the future is going to look like. And if they're not quite sure whether we're going to have small tariffs, big tariffs, or no tariffs at all, it creates a lot of problems with the economy. And this is a prime driver of the current volatility in the stock market. So one of the things that we want to look at is the data, and specifically the data regarding recession. In fact, if you remember a lot of the previous videos and market updates I've done, I was expecting a recession last summer. And here we are in March of 2025, and we have not had this big recession. Or have we? There has been a lot of data that has suggested that we have been on a recessionary trend for quite some time. If you look at, for example, the data over 2024, we had 7,400 retail closures. These are places that consumers go to buy things. Now, of course, the retail closures have a lot to do with people shopping more online. But you have seen a big drop in consumer spending. In fact, the recent data that we see on the consumer spending, if we look at a basket of those retail companies, you can see the stock prices have really fallen off lately. And when you start looking at those numbers and some of those retail companies and their earnings, you start to get really concerned. Now, why didn't we have this recession? If we were expecting a recession as early as the summer of 2024, why has it not happened? And really, I think it's because of government spending. The United States government, since last summer, has spent trillions of dollars. Tons of stimulus have been sent out into the economy. In fact, in just the 20 days before Trump took office, just in those 20 days, the Biden administration spent $800 billion. In fact, there's actually an undercover video of one of the, I think it was the Environmental Protection Agency, one of the heads there, talking about what they were doing with spending and stimulating and sending money out in the last few days there. And they've got him on undercover video. He thought he was, I think, talking to some girl on a date. And they've got him on undercover video saying that he feels like they're throwing gold bars off the Titanic right now. And this was right before Trump took office. So when you see that kind of stuff, and you see this massive amount of spending and stimulus that came in, I think that is the main reason we have not seen a major recession, because of all of the government stimulus and spending. And I believe a lot of that spending and a lot of that stimulus has dried up. Now, in addition to this recession data that we've been seeing for a long time now, we actually have seen some positive economic data more recently. And these are things that are very positive for the economy. In fact, I saw a recent article that said the recession is canceled. And the reason that they are saying the recession is canceled is because manufacturing data, industrial production is actually going up. We had a spike. In fact, in the last month, manufacturing data, industrial production looks really, really good. And not only that, we're seeing a lot of companies that are planning on reinvesting back in the United States. We're seeing companies like Honda are now going to start manufacturing the Civic in the United States. We're seeing companies like Apple announce $500 billion in new investment here in the United States. We're seeing billions of dollars of new investment in data centers right here in the United States. And one thing that I look at that you may not see in the mainstream media, but it's something I like to pay attention to, and that is corporate insider buying. These are people that are the insiders in corporations, and they've been selling stock for many, many years. You've seen the insider selling. Well, more recently, we have seen a large amount of insider buying. These are people at companies where they know what's going on at the company. They know what the future of the company looks like. They know what the potential profitability of the company looks like, and they're buying their own stock. So let's talk about these tariffs and all of the chaos and uncertainty that they're causing in the market. First, I want to say that tariffs by themselves are not as big of a deal as everyone's making out. When you look at actual tariffs and the cost of the tariffs, it's based on foreign-made goods, foreign-made things coming in. I actually looked, for example, at a Ford F-150, which is the best-selling vehicle in the United States. It has a ton of aluminum. It's a big consumer of aluminum. And when you look at a 25% tariff on Canadian aluminum, it's going to cause the price of that F-150 to go up by $470. Now, on a $50,000 truck, I don't think that's a huge deal. The obvious question regarding tariffs, and that what everyone in the mainstream media keeps saying, is they're going to be inflationary. That is absolutely not true. In fact, tariffs are the opposite. They are deflationary. Anyone or any article that says that tariffs are inflationary, they don't understand how economics work. Now, I think a lot of the confusion regarding tariffs and inflation actually results in the fact that most people have confused the difference between inflation and rising prices. They're two separate things, and it's important to understand these are interchangeable, and a lot of people on television have confused the two, and they refer to inflation, and what they really mean is rising prices. What inflation is an expansion of the money supply, expansion of credit. This is an expansion of what we use to buy things, the money supply, the credit that we have. Prices are what things cost. Two completely separate things. Now, it is true that generally when we have more inflation, prices go up because you have more money, more credit chasing the same number of goods. And when the supply of goods go up, prices can go down. When the supply of goods go down, prices can go up. So of course in 2020, during the COVID, what happened is the prices of things went way up because people weren't working, and so the supply went down. They weren't making as many things. Supply went down. At the same time, the government pumped a bunch of stimulus into the economy, giving people more money. So now they had more money to buy fewer goods. So yes, inflation can cause rising prices. Tariffs, on the other hand, are completely different. What a tariff is a tax. It is a tax that the United States government is going to charge us on foreign-made goods. So what happens is you have the same amount of money, the same amount of credit, and the price of a foreign-made good goes up. What ends up happening is now you are paying more for that same good. And what that does is it means you have less money and credit to buy other things. That is deflationary. That is not inflationary. Tariffs are not going to cause prices to go up. It'll cause some prices to go up on French wine or Canadian aluminum or things that the tariffs are impacted by, but it's going to cause prices and other things to drop because we have a limited amount of money and credit. Now, if they increase money and credit, maybe they lower interest rates at the same time these tariffs come on. Now, of course, you have real inflation, which could cause rising prices. But tariffs themselves are deflationary. And I've got proof. In 2018, when Donald Trump announced all the trade war and the tariffs against China in 2018, lots of new tariffs went into effect. And we saw these tariffs hit the market. And what happened? The CPI index dropped in 2019. So the higher tariffs that we got actually caused inflation to go down in 2019. This is important. The inflation has nothing to do. So when I talk about this, it's important. When you talk about inflation, and I say inflation went down, what I really am trying to say is consumer prices went down. This is the CPI data. So it's important to understand the difference between the two because we use those words interchangeably. We can use consumer prices, inflation. We can talk about inflation going up, inflation going down. We may really be talking about consumer prices going up, consumer prices going down. So remember, the tariffs themselves are deflationary. And so hopefully the Federal Reserve can lower interest rates to give us more money supply, more credit in order to offset the tariffs, which are deflationary. Now, deflation can lead to a recession, and this is where they have to be real careful. These tariffs going up are not inflationary, they're deflationary, so we have to worry about the impact on the economy. And when you have a lot of deflation, then you could see a recession. This was the big reason that we saw all of the recession and really the Great Depression after the 1929 crash. We know the Smoot-Hawley tariff bill is attributed to part of the Great Depression, and that's because it was very deflationary. What the Federal Reserve must do is lower interest rates in order to combat the higher tariffs. And this is something that we don't know if the Federal Reserve is going to act in time. And there's also some other problems that lower interest rates are going to solve. Number one is we are now paying more in interest on the national debt than we are national defense. This is a real problem. And so ideally, they need to lower interest rates so the amount of interest payments that are going out on this debt is reduced. This will help the government from not having runaway debt, runaway deficits. So reducing interest rates would be a really good idea. So if we have the tariffs come on, we've got the deflation, we need lower interest rates. We got all this government debt, we need lower interest rates. Also, we have this corporate debt wall. This is a real problem. These are corporations that have debt that is going to mature and they're going to have to refinance, roll over this debt. And that corporate debt wall hits in 2026 at a peak, but it's really starting to hit this year. It'll be 2026, it kind of peaks out, and then 2027, it also is a very high point. So in those few years, we need lower interest rates. And if we don't have lower interest rates, we are going to get a recession. And so this is a real problem. I hope the Federal Reserve is on the ball here and they actually do what needs to be done to keep the money supply up to combat this. But at the end of the day, it's going to lead to higher consumer prices in the future. It's going to lead to quote unquote inflation. So we want to make sure that we keep all of our investments in the right things in order to combat what can be future inflation. Deflation now, but potentially future inflation going forward. One of the biggest challenges that I think we're going to face if we do see deflation, if you do see true deflation, the Federal Reserve does not lower interest rates, they keep interest rates too high. The big problem is the real estate market. We're already seeing some real slowdown. We're seeing a frozen real estate market. And generally, when you see real estate prices drop, that's when you can see some really bad recession economic data. And so we really want to try to avoid that if we can. And we know what's going to happen to real estate prices already in the event that they don't lower interest rates. The current 30-year fixed rate is just under 7%. It's about 6.75% as of today. This is a high number, and the amount of people that can afford to buy a house with that kind of interest rate is very small. So you have a market where not a lot of sellers, not a lot of buyers, and this is a problem. And we already know what's causing this. The prime reason that we have this real estate bubble that we have now, which is home prices that are too high compared to what they should be, the prime reason is the government. You've got Fannie Mae, Freddie Mac, FHA, and you can actually see what can happen if Fannie Mae, Freddie Mac, and FHA were not there to actually support the housing market. And the way that we can see this is what's called the condo blacklist or the HOA blacklist. See, this condo blacklist, what this is, these are the condominium associations, the HOAs in the country that you cannot get a Fannie Mae, Freddie Mac, or FHA loan. Now, this list was very small a few years ago, just 3-4 years ago. It's a very small list. Only a couple hundred condo associations were on the list. But what happened is in 2021, there was a big apartment that collapsed in Florida. It was called Seaside Condos. This thing dropped, it collapsed, killed a bunch of people. And so what happened is the government said, wait a minute, we're going to start blacklisting a lot more of these properties. If we think that there's a problem, there's some kind of construction default, there's a risk of a problem, we're not going to allow Fannie Mae, Freddie Mac, FHA, VA, we're not going to allow these loans on those properties. So what ended up happening is they started blacklisting all these different associations around the country. And that list went from a couple hundred up to 1,700 in a very short period of time. Then they said, wait a minute, we also have a problem with wildfires in California and hurricanes in Florida and other areas of the country that have higher natural disasters like Hawaii. These kind of places, we're going to go ahead and we're going to blacklist all the condo associations that don't have enough insurance. So if you don't have enough insurance according to our guidelines to cover for fires or hurricanes or these kind of things, we're going to blacklist you too. Well, this blacklist has been growing exponentially. They're up to 5,500 associations around the country that are blacklisted. And we know the result in the values of those properties versus properties that can qualify for an FHA, a VA, a Fannie Mae, or a Freddie Mac loan. And the result is 30 to 40% drop. That's exactly what we're seeing. Those properties that cannot be covered by the government mortgages, those properties are worth 30 to 40% less than comparable properties in the same market. So without the Fannie, Freddie, all of these, you're going to have a big drop in home prices to the tune of 30 to 40%. Now, should the government be backstopping 90% of all the mortgages in the country with Fannie Mae and Freddie Mac and FHA and VA? Should they be backstopping all of these mortgages? The answer is probably not. And I haven't heard anything yet, but it would not surprise me to see Donald Trump and Elon Musk go after Fannie Mae, Freddie Mac, FHA, VA. It hasn't happened yet, but it would not surprise me. So if that happens, you are going to see a drop in home prices. And that is a real problem for the economy. That is something that leads to recession, drop of home prices. Now, I don't think Trump would care. Honestly, I do not think Trump would care if home prices drop, because you have to look at who wins and who loses. People that own houses, that already own houses, they're making their mortgage payment, or maybe it's paid off. If the value of their house drops 30 or 40%, it's not going to have a huge impact on their life because they live in the house. That's it. They already live in the house. If they have no mortgage payment, or their mortgage payment's a set 30-year fixed, they're going to make the same payment whether their house is 30 or 40% less than it is today or not, right? So it doesn't impact those people. It's a huge benefit for people that want to buy a house. So younger people that maybe can't afford to buy a house now, if the prices drop 30 or 40%, maybe they can afford to buy a house now. So this could benefit a lot of people. However, it is going to really, really hurt people that own properties as rentals. These are people that own single family homes, condos as rental properties. Those people would get really, really hurt. If you compare the people that could benefit versus the people that could get hurt, I think Trump would like to see home prices drop. So when you start to look at these numbers, yeah, if the Federal Reserve doesn't start lowering interest rates and they go after Fannie Mae and Freddie Mac, we could have a problem. So my suggestion is, don't worry about it if you're just a homeowner, or maybe you're someone who's looking to buy a house. Great, this might be good news. But for those of you that own rental properties, specifically ones that are covered by conventional loans, so I'm talking about single family homes, condos, maybe duplexes, threeplexes, fourplexes, not commercial property, not apartment buildings, not some of the stuff we have that has really good free cash flow. I'm talking about those single family homes and condos. You need to sell them. And I think it's a real risk to hold on to those at this point. You have a frozen market. If that market starts to thaw out, you're going to see property values drop. If they go after Fannie, Freddie Mac, you're going to see those property values really drop. And now's a great time. We can do a 1031 exchange. We do tons of these. We do 1031 exchanges all month long, one after another. Every single month we're doing 1031 exchanges for our clients. They sell their investment property, their condos, their single family homes, and then we transfer the money to a really good real estate investment that qualifies for a 1031 exchange. We can go into apartment buildings, storage units, assisted living facilities, memory care. There's all kinds of good real estate. We can even go into oil and gas investments that get a profit when people heat their homes and use gas for their automobiles. This is a real opportunity. And right now we're looking at cash yields in the 6, 7, 8% range, which is far higher than what we're seeing on return on investment on people that own these condos, own these houses. The return on investment, the ROI, might be 3 or 4% here in San Diego. Now, some areas of the country, if you're in Tennessee or Texas or Indiana, you might be getting 5 or 6% ROI because the value of the properties are not that high. The rent's pretty good. But here in San Diego, the rent is really pathetic compared to the high property values. Now's the time to get out. The 1031 exchange makes a lot of sense, and especially when you think about the risk to Fannie Mae and Freddie Mac and the current high interest rates. One hot topic on the internet and in the news media is gold. The price of gold hitting all-time highs, over $3,000 an ounce. It is a big deal. What is causing this? Why is the price of gold going up so much? Well, it's a combination of factors. One, you have high demand for gold around the world. Central banks are buying it. There's a lot of countries that are worried about U.S. treasuries. They're replacing U.S. treasuries with gold. And this is an institutional buying that's happening. A lot of retail people, they're not buying gold. There's actually been net outflows of retail investors in gold over the last year. You're seeing less people own gold. But the institutions, the central banks, the people that really understand what's going on, they're going wild buying gold. And that's one of the reasons that we have large positions in gold with our clients, because gold hitting all-time highs, this could just be the beginning. Now, I do think that we will probably have a pullback. We are obviously way ahead of what my expectations were. I expected gold to hit $2,500 by the end of 2024, back when it was $2,000. You can watch the video when I talked about I expected gold to be $2,500 at the end of 2024, at the beginning of 2024. It hit $2,800, and now it's over $3,000 an ounce. One of the things we are seeing, which is unusual, and I have no idea, I've looked into this, I've tried to figure out what's going on, but we are seeing massive shipments of physical gold. And believe it or not, it's coming to the United States. We're seeing gold being shipped, tons and tons, thousands of tons of gold is moving mostly from Europe to New York. Now, why is all this gold being shipped on boat, on plane? All this gold is coming in. It's coming from Switzerland. It's coming from London. Massive amounts of physical gold. The answer is, I don't know. I've looked into this. There's a lot of conspiracy theories. I don't know if any of these have any truth to them. One is that they're going to do an audit on Fort Knox and they're trying to replenish all the gold. I find that hard to believe. I would be shocked if the gold that the government says is in Fort Knox wasn't there. So I think that's a bit of a conspiracy theory, but that's one of them. Another conspiracy theory is the United States government and Trump is going to announce gold-backed treasuries. Now, this is more realistic. That is a possibility. Maybe they're going to issue treasuries backed by gold. Right? This is something that John F. Kennedy worked on in the 1960s, right before he was assassinated, backing currency with silver, with gold, talking about reintroducing silver certificates and gold certificates. One thing that might make a lot of sense, and there has been some talk about this, is gold-backed treasuries, specifically long-dated treasuries. Maybe the government would like to issue 20-year, 30-year, 50-year treasury notes that pay interest, and at the end of the maturity, they pay in physical gold. I think that would be a very positive thing. I think it would help protect the US dollar. It would create a lot of stability to the US markets. So gold-backed treasuries make a lot of sense. The third conspiracy, which is one that I hope is not true, and it is a concern, is that gold shipping all over the world is a sign that we are going to enter a further deterioration of war. When you look at the Ukraine situation, I know Trump is working on a peace deal between Russia and Ukraine, and no one's happy on either side with what they're getting out of the deal. That peace deal, if the Europeans end up trying to press for war instead of peace, that would potentially cause a lot of people that own a lot of gold to want to get that gold out of Europe. In the event a big war breaks out in Europe, typically you don't want to have your gold where troops can come in and seize that gold. And so one of the reasons that gold may be moving from Europe to New York, the physical metal, is to protect it before war. And this happened in the past, before World War II, before World War I. You saw a lot of gold being shipped around, kind of like pieces moving on the map of the globe in order to protect those gold supplies before a major war. Hopefully that is not the case. I hope that there is not war being planned and an escalation of what's happening in Europe, but that is a concern and I am watching it. Again, these are all conspiracy theories. I have absolutely no idea if any of these things have any truth or any merit to them. I've looked into this and I honestly don't know why all this physical gold is being shipped across the ocean to the United States. It is something I am following. I'm interested in it. If any of you have any interesting insight, feel free to reach out. Send an email to support@copleyfg.com and we'll be happy to take a look. And I'd like to hear what other people think because honestly, I don't know why. One thing I do know when it comes to gold is the gold mining companies need to catch up. The price of gold is over $3,000 an ounce. And the gold mining stocks, although they've gone up quite a bit recently, they have not gone up nearly enough to catch up with the gold price. So I think there's a real opportunity, and obviously we have some nice positions in the gold mining stocks. And what you're seeing is if you actually look at these companies and what their earnings estimates are, a lot of these companies, when you dive into it, these analysts for the gold mining stocks, they're assuming that gold prices are going to be $2,600 in 2027. It's already over $3,000 an ounce. So they are assuming that gold prices are going to drop from where they're at now all the way down to $2,600 over the next 2 years. I find that hard to believe. I think there is a real possibility the price of gold drops to $2,600 maybe in the next 6 months if we see a big pullback in the price and all the weak positions get sold out before the next run up. But 2 years from now, I would find it hard to believe that gold prices were under $3,000 an ounce. In fact, I think there's a much more likelihood that they're $4,000 or $5,000 an ounce with the current trajectory that they're on. So, gold mining stocks, they need to catch up. That is an opportunity, and we are trying to take advantage of that. Now, in light of all of this market data, all of this update, the bottom line is we're prepared for this. It's the reason that our clients are doing very well in this environment. They're not seeing big drops in their accounts like the people that are invested in Tesla and Nvidia. It's because we are prepared for what is going on. And we're going to do exactly what we've been doing going forward. Nothing changes. We want high quality value stocks, companies with good free cash flow, companies with dividends. We want those value companies which are doing much, much better than the growth companies that are stock prices are going down right now. We also want to make sure we continue to invest in the buffered index portfolio. This is the portfolio that can go up with the stock market up to a cap, and it has insurance in case the stock market goes down. So the one that we have available right now is a 24-month, 2-year, 19.3% cap with a 20% dual directional insurance policy. The way this works is you're in the S&P 500. If the stock market goes up 10%, you get 10%. If it goes up 15, you get 15. If it goes up 19%, you get 19. If the stock market goes up 25 or 30%, you only get 19.3. That's the cap. You are agreeing to give up everything above 19.3. In exchange, we have an insurance policy that if the stock market starts dropping and it goes down over the next 2 years, you actually make the inverse return, the opposite return, all the way down to 20%. So if the stock market goes down 12%, not only do you not lose, you make 12%. If the stock market goes down 18%, not only do you not lose, you make 18%. Now, if the stock market goes down 25%, you are actually going to lose 5%. And that's because that inverse return only is good down to 20%. So if the stock market's down 20%, you make 20%. But if the stock market is down 21%, you lose 1% because the maximum reimbursement then kicks in, which is a 20% reimbursement. So if the stock market again is down 25%, you would be down 5% because you'd get reimbursed 20 of your 25% loss, and you'd still be down 5. Now that is the first buffered index portfolio. The second one we have available is an 18-month. It's at 13.1%. That's the cap. Now that's over 18 months. So annualized, it's about an 8.7% return on the upside. So 13.1 over 18 months. This one is not dual directional, but the insurance is 100%. So you cannot lose any money. If the stock market goes down at all, you just get your principal back. Very nice policy, 13.1 cap. It's a good investment for someone who's very, very risk averse. I kind of like the dual directional one. If the market's down 10%, not only do you not lose, you make 10%. So I like that opposite return on the buffered index portfolio. But if you absolutely say, I don't want any risk, if the market's down 30%, I want to get fully reimbursed, then you could go with the 18-month that has that 100% protection. So those two buffered indexes are great. Those are products that we highly recommend right now in this environment, especially with this kind of volatility that we're seeing. We also are taking a look at investments in stocks that are inflation hedges. And so we do this. We want to make sure that you are invested in gold. We want to make sure you're invested in energy and agriculture and real estate, things that do well in an inflationary environment. Now, Matt, you think that deflation is a problem. I do, but I think that there's going to be a response to that deflation. The tariffs cause deflation. I think there will be lower interest rates, an increase in the money supply, an increase in credit that will offset it, which is inflationary. That is an expansion of the money supply. So I want to stay in those investments. I also want to get a good interest rate on cash that's insured, that's guaranteed, that I can't lose. We currently have our multi-year guarantee annuity, our MIGA, paying 5.5%. This is either on a 3-year or a 5-year basis, 5.5%. Now, in the event you want some liquidity on this during the term, you can choose a 5.35% and have 10% liquidity access. So that means that if you put in 100,000, you're getting 5.35, you can get it 10,000 each year during the term. Now, if you don't need access and you say, look, I just want to put my money away for 3 years or 5 years and get the highest guaranteed can't lose interest rate, you can get 5.5%. Now that is significantly higher than a lot of the bank accounts, savings accounts, other insured assets that I'm seeing right now. So it is a great option for someone who just wants guaranteed interest. I hope this was a good market update. And if you have any questions, feel free to reach out. You can call us, you can email support@copleyfg.com. And I hope to see you in our Mission Valley office very, very soon.